Hello Accounting 101 students. In this video, we're going to go over Chapter 5, end of chapter practice question number 6. And in this problem, we are given a large amount of data. And with this data, we need to prepare the multi-step income statement. We need to prepare the retained earnings statement and the classified balance sheet. And you've learned about the multi-step income statement in Chapter 5 of our textbook. We are going to be calculating the profit margin and gross profit rate. And also we're going to go through a scenario, what if we were to revise the net income? What would be the impact on the profit margin and the gross profit rate? So to get started with this question, we have Wolford Department Store. And net income has been declining. So we're going to be looking at the adjusted trial balance to put together that multi-step income statement. So when we look at our accounts, we want to first identify what accounts relate to our income statement. So when I look at this listing, I'm going to see cost of goods sold. That's the cost of the products that are sold. I'm going to see freight out, as well as depreciation expense, the gain on disposal, as well as a few more expenses right here. We also have our advertising expense and our rent expense, our salaries and wages expense, our sales revenue, and we also have our sales returns and allowances and utilities expense. So the first thing that you want to do is identify what accounts are going to be included in that multi-step income statement. And our multi-step income statement is going to be our revenues minus expenses equals net income. The only difference is that we always look at our net sales. So our net sales is going to be our sales revenue minus our sales returns or allowances minus your sales discount. So that will equal your net sales. So that'll be the starting point for the revenue portion. Then we need to list out our expenses. One of the things that you want to pay attention to is that in the multi-step income statement, we're going to subtract out our cost of goods sold expense. That is the cost of the products that we are selling to our customers. And we're going to have a subtotal for the gross profit. So our gross profit is our net sales minus your cost of goods sold. And this is a key figure for a merchandising company. Next, we're going to be subtracting out all of our operating expenses. So some of the examples of operating expenses can include salaries and wages expense. We might have an expense such as depreciation. We might have our insurance expense, our rent expense, advertising expense, and so forth. These are common expenses that we see for most businesses. And we want to have a subtotal for our total operating expenses. After we have our total operating expenses, then we have our income from operations. And our income from operations will be our gross profit minus these operating expenses. So this is also referred to as operating income or income from operations. From our operating income, we now need to look at our non-operating income and expenses and gains and losses. So for this section, depending on what the item is, we're going to either add or subtract our non operating income. So this can be something like interest revenue or the gain on the disposal of a fixed asset. We're also going to, so these are all things that we're going to add. The things we're going to subtract is going to be our non-operating losses or expenses. So once we take care of these items, we're going to get our income before taxes. And from there, we're going to subtract out our income tax expense. So this is also referred to as the provision for income taxes or income tax expense. And then we're going to arrive at our net income. So we can see that we have a lot more steps in this process. So now we're going to go ahead and look at our multi-step income statement based on the accounts that we've identified. So our multi-step income statement, it's for the year, and it's going to start off with our sales. And in our sales section, the main thing we want to get to is our net sales. So we're going to take our sales revenue, you'll include the number that you have in your problem, minus or less the sales returns and allowances to arrive at your net sales. If you had a sales discount, you would also subtract that out. Then you have your cost of goods sold that you're going to subtract in order to arrive at the gross profit. For operating expenses, we have salaries and wages expense, rent expense, advertising expense, depreciation expense, utilities, insurance, and freight out. So all of these in Wiley are listed from largest to smallest, and we're going to have our total operating expenses. Then we get to our income from operations, which is also referred to as our operating income. We're going to have our section on other revenues and gains. So if you had a gain on the loss or a gain on the disposal of the plant assets, it would be in the other revenues. If you had a loss, it would be in the other expenses and losses. Interest revenue will belong in the other revenues and gains. Interest expense belongs in other expenses and losses. And you'll arrive at your income before taxes. From there, you're going to subtract out your income tax expense in order to arrive at net income. You're going to need to prepare your retained earnings statement next. From the data given in the problem, you're given the beginning retained earnings. You're going to add the net income from that income statement to get a subtotal. From there, you're going to subtract out dividends and then arrive at your ending retained earnings, which you'll use for the balance sheet. The information in your classified balance sheet is similar to what you have learned earlier in our semester. In our current assets, we have cash, accounts receivable, inventory, prepaid insurance to get to our total current assets. Then we have our property, plant, and equipment, which will include equipment less accumulated depreciation to arrive at your total assets. Liabilities and equity, we have accounts payable and salaries and wages payable as our current. Our long-term will include notes payable. And in our equity section, we have our common stock and our updated ending retained earnings. And you'll want to make sure that your total assets equals your total liabilities plus equity in the balance sheet. The next part of this problem is computing the profit margin and the gross profit rate. So in this problem, if you look at our data, our profit margin is going to be this amount that we have for our net income from our income statement. So you need to make sure that you do this problem in order to get to your net income on the income statement. And we're going to go ahead and divide that by our net sales. So your profit margin is going to be your net income divided by your net sales. Then we have our gross profit rate. So for our gross profit rate, we're going to need to take our gross profit and divide it by the net sales. So basically we want to see from our revenues how much is taken up by our cost of goods sold and what's remaining, okay? So this gross profit rate is really important in a manufacturing and a merchandising business. Then we have two scenarios. We have the Vice President of Marketing and Director of Human Resources are developing a proposal where they're trying to think about, will we compensate our sales force strictly on a commission basis? So if they do that, then they will expect net sales to increase by 15%. And if they do that, they're going to estimate that their gross profit will increase by $59,000 and expenses by $85,000. So what we want to do is, considering the scenario, right? We're going to expect net sales to increase. That's one factor. And also the gross profit increasing and expenses increasing. And if Human Resources wants to go forward with this proposal, we want to compute the revised profit margin and gross profit rate. So to do this, first we need to revise our net income. So we're going to go ahead and take our current net income that was initially given to us in our income statement. And from this scenario, we're expecting gross profit to increase, which will increase our net income. And then also an increase in operating expenses is going to reduce our net income. So that's the reason why we're going to subtract that out. So we're going to get a revised net income. Also with this scenario, we expect our net sales to increase by 15%.